Corporate governance relies heavily on the audit function to promote transparency, accountability, and confidence in financial reporting. Auditors provide independent assurance that financial statements fairly represent a company's financial position and performance in accordance with applicable accounting standards. By verifying the reliability of financial information, auditors help reduce information asymmetry between management, boards of directors, shareholders, creditors, regulators, and other stakeholders. Within effective governance frameworks, auditors serve as an important monitoring mechanism that strengthens oversight, supports investor confidence, and contributes to efficient capital markets. The audit process therefore plays a critical role in safeguarding financial integrity and reinforcing trust in corporate reporting and governance systems. One of the most important governance principles relating to auditing is the independence of audit firms. Auditor independence is essential because stakeholders rely on auditors to provide objective and unbiased assessments of financial information. Independence may be threatened when audit firms develop overly close relationships with clients or derive substantial revenue from consulting and advisory services provided to the same organization. These situations can create actual or perceived conflicts of interest that undermine confidence in audit quality. Strong governance frameworks therefore emphasize auditor objectivity, professional skepticism, ethical standards, and safeguards designed to minimize conflicts. Maintaining independence remains one of the most significant challenges facing the auditing profession. To address concerns regarding familiarity and independence, many jurisdictions have adopted auditor rotation requirements. Auditor rotation may involve changing the lead audit partner after a specified period or requiring periodic replacement of the external audit firm. The primary objective is to reduce the risk that long-term relationships between auditors and management compromise professional skepticism and objectivity. Rotation can introduce fresh perspectives and strengthen stakeholder confidence in audit outcomes. However, it may also create challenges because new auditors require time to understand complex business operations, internal controls, and industry-specific risks. Consequently, regulators and organizations seek to balance independence benefits with continuity and audit effectiveness considerations. Another challenge involves the sampling nature of audit work and the impact of technological disruption. Auditors generally examine selected transactions and controls rather than reviewing every activity conducted by an organization. Sampling allows audits to be completed efficiently but introduces the possibility that certain errors, irregularities, or fraud may not be detected. Advances in technology are transforming this process through data analytics, artificial intelligence, automation, and continuous auditing techniques. These innovations improve the ability to analyze larger data sets and identify anomalies. However, technological disruption also creates new risks related to cybersecurity, algorithm reliability, data quality, and the need for auditors to develop increasingly sophisticated technical expertise. Auditor reports are a key output of the audit process and serve as an important communication tool between auditors and stakeholders. Audit reports provide opinions regarding whether financial statements present a fair and accurate view of an organization's financial position and performance. Modern reporting frameworks increasingly require auditors to communicate key audit matters, significant judgments, risks, and areas requiring particular attention. Enhanced reporting improves transparency and helps investors better understand complex accounting issues and financial reporting risks. Nevertheless, challenges remain because users may misunderstand the scope of audits or expect auditors to provide assurances beyond those intended under professional auditing standards. The issue of auditor liability further influences audit quality and corporate governance. Auditors may face legal, regulatory, and reputational consequences if audits are performed negligently or fail to identify material misstatements. Potential liability encourages adherence to professional standards, thorough documentation, and rigorous audit procedures. However, excessive liability exposure may increase audit costs, discourage professional judgment, or reduce competition within the audit industry. Balancing accountability with practical audit limitations remains an ongoing challenge. Investors and regulators expect auditors to provide meaningful assurance while recognizing that audits offer reasonable, rather than absolute, assurance regarding the accuracy of financial statements, and internal control effectiveness. In addition to external auditors, internal audit functions play a critical role within governance systems. Internal auditors provide independent assurance and advisory services designed to improve risk management, internal controls, governance processes, and operational effectiveness. Unlike external auditors, internal auditors work within the organization and report to the board or audit committee while maintaining operational independence from management. They assess compliance, evaluate control environments, identify operational risks, and recommend process improvements. Effective coordination between internal and external auditors strengthens governance oversight and enhances organizational resilience. Together, independent external audits and robust internal audit functions contribute significantly to financial integrity, stakeholder confidence, risk management effectiveness, and sustainable corporate governance practices.